So that S&P 500, right, dropping 10% like that from its February high, too.
Yeah.
It makes you wonder, doesn't it?
Absolutely, especially with it happening so fast.
Right. In just a couple weeks, basically.
Makes you think.
And if you're holding, like, those high-growth stocks, those momentum plays,
Oh, yeah.
I bet it's felt even wilder, right?
I bet.
It really makes you think, is this, like, the time to buy, maybe some great stocks are on sale now, right?
Right.
Or is this the start of something worse?
Yeah, that's the big question, isn't it?
It is. It is.
Like, buy the dip or brace yourself.
Exactly. And that's what we're diving into today.
We are.
This report, what was it called? Buy the dip now, I think.
Buy the dip now, yeah, from March 24th, 2025.
Right.
Argues this is exactly it, a buying opportunity.
Okay, so let's
It is.
let's unpack that, right, for everyone.
Yeah, let's break it down.
Let's look at the arguments.
See if they hold water.
Exactly, see if they make sense. So the report, right off the bat, starts talking history.
Oh, yeah. Loves the historical perspective.
They go all the way back to 1980.
Wow.
Looking at market corrections, and I think the first things they point out is that even with like an average drop of 14% each year.
Every year.
Wow. Yeah, the market still gains 10% on average.
Still positive overall.
And it ends the year, higher, 70% of the time.
So most of the time, you're still coming out ahead.
What do you make of that?
Well, what stands out to me there is, the difference between like what happens day to day or week to week even, and then where things end up over a longer period.
Right.
It's like those short-term drops.
They can feel really scary.
They can in the moment.
Yeah.
But,
Yeah.
they're not always a sign of like the long-term trend.
They're part of the process.
Exactly. Part of the ups and downs.
And the report, to prove this point, it goes even further back to 1965.
Wow, they did their homework.
Yeah, they looked at all the S&P 500 corrections and get this, when there wasn't a recession happening at the same time, the drops were smaller.
Okay, so not as bad.
Yeah, like around 15%, and they didn't last as long either.
So a little over 3 months.
Yeah, and the report thinks that, this time we're probably not going to see a recession either.
Interesting.
Right. So tying that back to today,
Yeah.
knowing how the market usually acts when the economy is okay,
Right.
that could be really useful
Yeah, it definitely gives us some context.
to understand how deep this dip might go and how long it could last.
Right, assuming the report's right about no recession, of course.
Okay, so speaking of recession, let's talk about that.
The big R word.
Because, 2023, even 2024, everyone was worried about a recession.
Yeah, it was all over the news.
But this report, it actually says maybe not.
Okay, so what's their reasoning there?
Well, they focus on, get this, consumer spending.
Consumer spending. Okay, that's a big part of the economy.
Exactly. But here's the thing.
What is it?
The wealthiest 10% of households,
Okay.
they're now driving half of all consumer spending.
That much?
Yeah, up from 38% back in 1995.
That's a big shift.
So if we want to see a recession,
Yeah,
these folks, the wealthy, they'd have to really cut back their spending.
I see. And the report's saying that's unlikely.
Yeah, and they point to the job market, too.
Makes sense.
Weekly jobless claims, they're around 240,000.
That's pretty low, right?
Way lower than, a typical recession.
What do they usually see during a recession?
They said around 400,000.
Wow, that's a big difference.
In Wall Street, they're still expecting the economy to grow this year.
Okay, so the experts are still optimistic.
Between 1.5% and 2% real GDP growth.
So not a boom, but not a bust either.
Right, it's like a slow and steady kind of thing.
Makes sense.
But not just the job market. The report also looks at something called high-yield credit spreads.
High-yield credit spreads.
Yeah, it's basically how much extra investors want to get paid.
Paid for what?
For holding on to riskier company bonds compared to, government bonds.
So it's a measure of risk, right?
Yeah, exactly. And right now, those spreads are super tight.
Super tight. What does that mean?
It means they're low.
Oh.
3.4% above Treasury yields.
It's low.
It's near record lows. Yeah, way below the 20-year average, which was over 5%.
So the report's interpreting that as the market not seeing a recession coming.
Exactly, because if things were going south, those spreads would be way wider.
Right. Investors would demand more to compensate for the risk.
Exactly. So what do you think about all these signals? The job market, the spending, the credit spreads?
What strikes me is, they're all kind of pointing in the same direction, right? It's not just one good data point.
Right.
It's like a whole bunch of them, all suggesting that the economy might slow down a bit, but it's not, falling apart.
Yeah, it's more of a a soft landing, maybe.
Yeah, that's a good way to put it.
And then on top of all that, the report brings up investor sentiment.
Investor sentiment. That's always interesting.
And they say it's super bearish right now.
Oh, so people are feeling negative.
Way more bears than bulls, according to this survey from the American Association of Individual Investors.
AAI, yeah.
Right. And the report says this is some of the most bearish sentiment we've seen in 40 years.
Wow. So everyone's thinking the market's going to crash.
Pretty much, yeah.
So how does the report spin this as a good thing?
Well, this is where it gets interesting, right? It's all about being a contrarian.
Contrarian, like going against the crowd.
Exactly. The report says that historically, when sentiment's been this negative, the S&P 500 has actually done really well over the next year.
So it's a buy signal.
They say it's averaged like a 13% gain after similar super bearish readings.
That's a pretty good return.
And like on the flip side, when everyone's been super optimistic,
Yeah.
those gains have been much smaller, closer to 6%.
So it's like when everyone's gloomy, that's when you buy.
It's like the market's already priced in all the bad news.
I see. So there's less room for it to go down.
Exactly, and any good news could push it way up.
Interesting.
Especially since the report's pointing out that this bearish reading's in the top 25% historically.
So really bearish, even compared to other bearish times.
Right.
So we've got history on our side. Maybe the economy's not as bad as people think, and everyone's already freaking out.
Yeah, that's the report's argument in a nutshell.
Okay, but what do we actually do with this information?
Right, so the report then starts talking about market leadership and how it might be changing.
Changing how?
Well, you remember those Magnificent Seven stocks?
Those huge tech companies, yeah.
They were killing it in 2024, but this year, not so much.
So they're not leading the pack anymore.
Exactly. And the S&P 500 equal weight index, where every stock has the same impact,
Right.
It's actually doing better than the regular S&P 500.
Interesting. So maybe the smaller companies are doing better now.
That's what it looks like.
So what's the takeaway there?
Well, it could mean that the market's like broadening out,
Broadening out.
Yeah, like there are opportunities beyond just those big tech names.
Okay, so we need to look beyond the usual suspects.
Exactly. And the report, they actually did a screen of the whole S&P 500.
A screen?
Yeah, looking for like hidden gems. They called them battle-tested stocks.
Battle-tested stocks. I like that.
And they used these map scores, which
What are those?
it's like their own way of ranking companies based on their financials, like profitability, debt,
Yeah.
and also how well their stock's been doing recently.
So looking for companies that are both fundamentally sound and have some momentum.
Exactly. And guess what? No big tech companies made the list.
Really? So who did?
It was mostly companies in sectors like financials, industrials, healthcare.
Okay, more traditional industries?
Right. More like value plays, I guess.
So why is the report highlighting those types of stocks now?
They say these companies could be more like resilient,
Resilient.
Yeah, if the market keeps bouncing around.
Okay.
But they could still do well if the market rallies.
So kind of best of both worlds situation.
Yeah, and they point out that these companies, they tend to have like really solid businesses.
What does that mean specifically?
Like good profits, steady earnings growth, not too much debt, strong balance sheets.
Those good things, yeah.
The kind of stuff investors like when things are uncertain.
Makes sense.
It's like after years of chasing growth,
Yeah.
now it's back to basics.
Back to the fundamentals.
Exactly. And they do mention, the report, that just going all in on super defensive sectors.
Like what kind of sectors?
Like, consumer staples, utilities, pharmaceuticals.
Okay, the ones that tend to do well no matter what.
Yeah, they say that might limit your gains if the market takes off.
Right, you might miss out on the upside.
So it's about finding that balance,
A sweet spot.
right, between playing it safe and being ready for a rebound.
Makes sense.
So to kind of sum it all up, this Buy the Dip Now report, they're saying this pullback, even though it's been rough, could actually be a good thing based on like the historical pattern of corrections, the economic outlook, which I think is okay, and the fact that everyone's already super pessimistic.
Right, the contrarian view.
Exactly. And they think this shift towards these like more fundamentally sound companies.
Yeah, the battle-tested ones.
Right. That could be the key to navigating the market right now.
So lots to think about.
Lots to think about. Yeah.
I mean, the historical perspective definitely helps put things in context, right?
It does.
And the economic data, well, it's not all sunshine and rainbows, but
It's not doom and gloom either.
exactly. And then that investor sentiment piece.
It's almost like the more scared everyone is,
Yeah.
the better the opportunity might be.
Contrarian play.
Right, and this idea that different types of companies might be taking the lead now.
That's a big one.
It really makes you think, like, do I need to adjust my strategy?
Yeah. Are you in the right stocks for this market?
Exactly. So I think this deep dive, it's given us a lot to consider
A lot to chew on.
as we think about, like, what to do next with our investments.
So what parts of this resonated most with you?
That's a good question.
What new questions does this raise for you?
Because really, that's where the real work begins.
Figuring out your own path forward.
Exactly. Thanks for joining us for this deep dive.
And happy investing, everyone.
We'll see you next time.